All right, let's take a deep dive into the new CPI data, which came in lower than expected for November at 7.1%. The expectation was for 7.3%. President Biden held a press conference after the numbers were released and shared when he thought prices would come back down to earth. Let's listen.
When do you expect prices to get back to normal, Mr. President?
I hope by the end of next year we're much closer, but I can't make that prediction. I'm convinced they're not going to go up. I'm convinced they're going to continue from there.
Joining us now are Nancy Tengler, Laffer Tengler Investment CEO and Chief Investment Officer, and Kathy Bostjancic, Nationwide Chief Economist and Senior Vice President. Nice to see you both. Lots to get to. Nancy, we'll start with you, and we'll circle back to the CPI in a moment. But first, just a discussion of the markets, which are up. The Dow, more than 700 points at one point, fell into the negative earlier, and now up slightly. What do you make of it?
This is what we've had this year. I think over 80 or 90% of the days that we have in the books this year, the market has traded above or below in terms of percentages by 1 full percentage point. That kind of volatility is we haven't seen it for quite some time. So I think, in the morning you get the algorithms that read the headlines and they drove that early rally. But then there was an opportunity for some people to take some gains off the table. And so we think that's what kind of drove it through the rest of the day. But we're never looking on a minute by minute, day by day basis. We're looking out 3 to 6 to 9 months. And I actually think the news was excellent and will continue to happily surprise us as inflation becomes disinflation in the coming months. So I like where we held on to. The Nasdaq's up almost 1%. It has the longest way to go. And so I'm glad to see that some of those stocks are holding up really well.
So, Nancy, you were encouraged by the number that we got. Kathy, what did you think of it? Because, yes, certainly inflation, that picture improving, but that 7.1% print showing that inflation is still very sticky.
That's right. It's an encouraging number, and certainly it's great when you see a number, the monthly change beat expectations. But as you said, we're still above 7% on the headline. Core inflation is still running at 6%. And when we take a look at what seems to be Chairman Powell's favorite measure now, core services excluding rents, that's still over 6% as well. So it's the service side is sticky. We knew goods prices would decelerate and some to outright fall. We didn't know the timing of it all, but that's not a big surprise. And the real issue is the service side of the equation.
And Nancy, it certainly will not influence the move from the Fed tomorrow, which by all accounts will be 50. How might it impact the commentary? And how do you believe the Fed chair views this number?
So I've been very critical of the Fed. I just want that on the table. They didn't create this problem all by themselves. The policymakers in Washington have spent a tremendous amount of money as people were going back to work and demand was at least moderating. I think what we're going to hear tomorrow is he's going to continue to be hawkish. That's his way of sort of jawboning markets to do the Fed's heavy lifting, which the markets actually have done. But I would also point out that you want to look at what the Fed's looking at. Of course, they're looking at PCE, which has less dependence on housing, for one thing, and on jobs. But if you do, you can't not look at the CPI. And if you annualize the 1 month and the trailing 3 months, which is what the Fed's really looking at when they look at the CPI, though that number is for the annualized, it's 2.4%, and for on a 1 month basis, and annualized last 3 months is 4.2. So after tomorrow's hike, the Fed funds rate will actually be above the level of inflation that we are expecting if it continues to move in a symmetric manner. And we have noted that it has done that since 1951. You're up 15 months and you're down 15 months. And so this is what we think is happening. It won't be a straight line, but we think that things have flipped over. And the last thing I'll say is that even in services, prices are coming down, and we're going to have that medical care tailwind to our backs, which was an anomaly that was pushing up CPI and will now actually provide a disinflationary impact as we move forward.
Kathy, how aggressive do you think the Fed needs to be or should be in the new year? And I guess, what do you think it's going to take in order for the Fed to maybe pause or essentially pivot?
Yeah, I think that, I agree with Nancy. I think for now they're going to continue to talk hawkish, especially since they're dialing back the size of the rate hike to 50 basis points. And there's still a lot of uncertainty. And even though inflation's moving in the right direction, we all applaud that. It could still be rather gradual and still well above 2% as we go into 2023. So beyond that, we think there is still another 75 basis points of rate hike, probably 50 in the following meeting, which is the end of January, and then a 25 in March. So that lifts the midpoint of the Fed funds target range to a little bit above 5%. And then we think they pause at that point and they hold that for all of next year. Markets have been really eager, though, to price in rate cuts and even the expectation and probability sometime mid-year next year. We think that's a bit premature to be thinking about that at this point, especially you should add that wage growth is still above 5%. So it's not just inflation. They also need to see wages get back to something closer to 3%.
A lot of investors anxious to hear the tone from Fed Chair Jay Powell tomorrow afternoon. Kathy Bostjancic and Nancy Tengler, thanks so much for joining us.